Most buyers just go with the first lender they talk to. Well, that's a mistake that could cost you thousands. Here are the 5 smart steps that buyers take to make sure they're getting the best deal and the 7 questions you should be asking every lender. Hello, I'm Frank Kenny with Living in Los Angeles South Bay. Today we're going to talk about how to choose the right mortgage lender because this decision affects your interest rate, your monthly payment, and how smooth or stressful the entire home buying process is going to be. I'm going to give you 5 steps and 7 questions that will put you in control. And before we get to it, make sure you like and subscribe so you always get the inside scoop on the housing market. So why does your mortgage lender choice matter more than you think? Well, here's what a lot of buyers don't realize. Not all lenders are the same. Different lenders offer different rates, different fees, different loan products, and different levels of service. The lender you choose can literally be the difference between a smooth closing and a nightmare, and between saving or wasting thousands of dollars. And yet most buyers just go with the first lender they talk to or whoever their friend recommended without doing any comparison. So don't be that buyer. Here are the 5 steps to doing this the right way. Step 1, that's know your financial picture. And before you talk to a single lender, you need to know where you stand financially. This isn't about being perfect, it's about being prepared. And there are 3 things you should have a handle on. First would be your credit score. Most lenders want to see at least a 620 or better. If you're at 740 or above, you're going to have plenty of options and qualify for the best rates. If your score is lower, you'll have fewer choices, but there are lenders who specialize in working with buyers who have credit challenges. So don't count yourself out. 2, your debt to income ratio. This is the percentage of your monthly income that goes toward debt payments. As a general rule, lenders prefer your housing costs to stay under 28% of your gross monthly income and your total debt payments, including housing, under 36%. Some loan programs are more flexible, but knowing your number gives you a realistic starting point. 3 is your budget. Have a general sense of what you can afford. This will also help determine what type of loan you need. For example, if you're buying in the South Bay here in Southern California where prices are high, you may need a jumbo loan, which has different requirements than a standard conventional mortgage. Now, step 2 is exploring your loan options. And once you know your financial picture, you can figure out what type of loan makes sense for you. And this matters because different lenders specialize in different types of loans. Here's a quick rundown. First are conventional loans, and they're issued by private lenders. You can qualify with as little as 3% down, but you'll pay private mortgage insurance, which is PMI, until you reach 20% equity. Almost every lender offers these. 2 are government-backed loans, which include FHA, VA, and USDA loans. They typically have looser requirements and some don't require a down payment at all. If you're a veteran, VA loans are some of the best deals out there. Now, number 3 are jumbo loans for homes above the conforming limit. They are harder to qualify for, but if you're buying an expensive market like ours here in Southern California, you may need one. Beyond the loan type, your situation matters too. If you're self-employed, you'll need a lender comfortable with non-traditional income verification. If you're a first-time buyer hoping to use down payment assistance, look for lenders who participate with your state's housing finance agency. The more specific you are about what you need, the easier it is to find the right fit. Step 3 would be to shop around, and seriously, this is important. This is the step most buyers skip, and it's the one that costs them the most money. You should be comparing at least 3 to 4 lenders before you commit. Start with your current bank or credit union. You're under no obligation to go with them, but it's a good baseline. Ask friends and family also for recommendations. Look at online reviews and pay attention to a few key things as you narrow your list. Some things you want to consider are customer service. Can you reach them when you need to? If their hours don't work with your schedule, that's going to be a problem during the busiest weeks of your closing. Also, sample the rates. Many lenders publish sample rates on their websites. Use these to get a sense of how competitive they are before you even apply. Also, special programs and perks. Some lenders offer discounts for existing customers, veterans, first-time buyers, or other groups. If you qualify for any of these, that's a factor worth considering. Step 4 is get pre-approved with multiple lenders. Once you've narrowed your list, get pre-approved with each of them. This is the only way to get a real firm number on what you can borrow and what your rate will be. During pre-approval, lenders will thoroughly review your credit and finances. You'll need to provide pay stubs, tax returns, bank statements, and other documentation. It's a little more work up front, but it gives you the information you actually need to make a smart decision. Oh, and don't worry about your credit score when contacting multiple lenders. Multiple mortgage inquiries within a 45-day window are treated as a single inquiry on your credit report. The credit bureaus know you're shopping around and they expect it, so talk to multiple lenders without fear. The pre-approval process will also show you which lender you will actually enjoy working with. Technology, communication style, and responsiveness, and these are things that matter when you're in the middle of a transaction. You will also want to contact the lenders generally in the same day or two because mortgage rates bounce up and down even daily. So you want to be able to compare apples to apples, and that means you should contact lenders on the same day, generally speaking. Now, step 5 is compare your loan estimates side by side. Within 3 business days of applying, each lender is required to give you a loan estimate. This is a standardized document that lays out the exact terms of your loan, interest rate, repayment term, and all of the fees. When you're comparing these, here's what to focus on. First, look at the APR, not just the interest rate. The APR reflects the true cost of the loan, including interest, mortgage, points, and fees. 2 lenders can offer the same rate but very different APRs due to the costs. Next would be check the third-party costs. Title insurance, appraisal fees, recording fees, transfer taxes, these all add up. Some of these are negotiable, and you can shop around for services like title insurance separately. Next will be looking for errors. Misspelled names, wrong account numbers, incorrect amounts. Catching these early saves you major headaches at closing. Once you've compared everything side by side, you'll have a clear picture of which lender gives you the best overall deal, not just the lowest rate, but the lowest total cost. Now here are 7 questions to ask every lender before you commit. These are the questions that separate informed buyers from everyone else. Number 1 would be, what paperwork do you require? 2, do you specialize in the type of mortgage I need? 3, how many loans of my type did you close in the past year? 4, how long does your rate lock last? 5, how long do your mortgages typically take to close, and how often will you fail to close on time? 6, what does your underwriting process look like? 7, how will I submit documents online, by mail, or in person? That last question might seem minor, but if you're someone who wants to handle everything online versus someone who wants to sit across a desk from someone else or their lender, it matters. So knowing the process upfront prevents frustration later. So what's the bottom line? Well, choosing a mortgage lender isn't something you should rush through or leave to chance. This is the biggest loan most people will ever take on, and the lender you choose affects your rate, your fees, your timeline, and your entire experience. So take the time to know your finances, understand your loan options, shop around, get pre-approved with multiple lenders, and compare those loan estimates line by line. It takes a little extra effort up front, but it can save you thousands and a lot of stress. Now, if you want help getting started or want me to connect you with lenders I trust here in the South Bay, reach out to me. I've worked with a lot of lenders over the years, and I know who delivers and who doesn't. And if you're an agent and you have questions about this topic, please reach out to me as well. I'm ready to help. Please like and subscribe so you're guaranteed to get all of our current helpful videos, and please feel free to share these useful videos with your family and friends. Well, I'm Frank Kenny with Living in Los Angeles South Bay, and I'll see you in the next video.